Welcome to this weekly installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week. My name is Summit Puri, and thank you for tuning in. This week, as usual, we'll discuss 4 key focus points highlighting key learnings from the market activities in the past week. In point number 1, we'll do a market recap with our key market indicators. In point number 2, we'll look at ISM Services Data. In point number 3, we'll look at U.S. NonFarm Payroll data. And in point number 4, we'll discuss in more detail the first rate cut decision of 2024. Now, on to point number 1, the market recap. First, each week we review the Atlanta Fed seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta GDP Now report shows a healthy 2.1% growth as of September 4th, which is up from the previous estimate of 2.0%. In the upcoming weeks, we'll add more context to this data by doing further drill downs into subcomponent contribution to continue to provide more insight to our viewers. Next, each week we look at the initial claims for unemployment insurance for a gauge into the front end of the labor market. This week, initial claims data came in at 227,000, a 1.7% decrease from last week, and continuing claims also fell by 1.36% to 1.838 million. Next, for 2024, we are watching mortgage rates closely to see how home affordability is trending. This week, rates remained relatively the same, with the 30-year and 15-year ending at 6.35% and 5.47% respectively. Next, we'll take a look at investor sentiment. One component of investor sentiment is the measurement of the bull to bear spread. The latest update shows the bull to bear spread falling slightly from 24.19% last week to 20.42%. This is a drop of 3.77% from last week, but is still significantly higher than the long-term average of 6.68%. Next, we'll continue to update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME Fed Watch tool is showing a 70% probability of a 0.25% decrease and a 30% probability of a 50 basis point decrease in September. We'll talk more about that in detail in point number 4. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which is our proxy for growth and growth in income, but only when considered together, ended negative 4.22%. The Russell 2000, which tracks small and mid-sized companies or aggressive growth in our Dave Ramsey vernacular, was negative 5.67%. And the MSCI EAFE, which tracks international stocks of developed countries across the globe, excluding the US, was negative 2.83%. We have a new leader in the mix again. International stocks took the win, I guess, as the smallest loser. Last week was a rough week for the markets as a whole, but to put this in perspective, it's important to take a look at the larger picture to understand the true impact to your portfolios. One small sample size should not impact your investing decisions. Let's take a look at this data at different time series. First, the 1-month trend. The S&P 500 ended positive 3.38%, the Russell 2000 was positive 1.46%, and the MSCI EAFE was positive 6.47%. Next, the 3-month trend. The S&P 500 was positive 1.39%, the Russell 2000 was positive 2.42%, and the MSCI EAFE was positive 0.31%. The 6-month trend. The S&P 500 ended positive 6.69%, the Russell 2000 was positive 1.87%, and the MSCI EAFE was positive 4.91%. And lastly, the 12-month trend. The S&P 500 was positive 22.91%, the Russell 2000 was positive 13.26%, and the MSCI EAFE was positive 18.12%. That last week doesn't look so bad anymore, does it? I say this every week, but I believe it's very important. Remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the markets are performing, but the importance of diversification. Nearly every time series we looked at today, we had a new leader. Appropriate diversification decreases your risk while exposing you to the upside. If you'd like an unbiased review of your portfolio, do not hesitate to contact us and connect with one of our advisors today. And on to point number 2, ISM Services Data. The ISM Services PMI registered 51.5% in August of 2024, indicating expansion in the United States service sector for the second consecutive month. This marks the sixth month of expansion in the sector out of 8 in 2024, signifying a positive trend. The Business Activity Index, a key indicator of current economic activity, registered 53.3%, revealing ongoing expansion, though at a slower pace compared to July. This steady growth suggests resilience in the service sector, which is a significant portion of the United States economy. The report released last week highlighted positive developments in new orders and employment within the service sector. The new orders index expanded to 53% in August, reflecting an increase in demand for services. This growth in new orders can be interpreted as a signal of continued confidence in the sector's future performance. Additionally, the employment index, while showing slower growth, still expanded for the third time in 2024, reaching 50.2%. This suggests that service businesses are continuing to hire, albeit at a more cautious pace, possibly influenced by economic uncertainties. While 10 service industries reported growth in August, 7 experienced a decrease, including significant sectors like retail, trade, and construction. Based on our research, this was attributed to factors such as high borrowing costs impacting the housing market and weak sales performance due to high food costs. Additionally, businesses across various sectors have expressed concerns about slowing foot traffic and economic uncertainty. These factors indicate potential vulnerabilities in the services sector that bear close monitoring in the upcoming months. Now, on to point number 3, non-farm payrolls. The August 2023 U.S. jobs report presented a mixed bag for the economy, with job growth rebounding but signs of potential slowdown still present. The Labor Department reported a gain of 142,000 jobs in August, exceeding July's figures but falling short of the average monthly gain over the previous year. While this rebound alleviated some fears of a significant economic slowdown, downward revisions to the June and July's job growth figures totaling 86,000 fewer jobs than initially reported injected a note of uncertainty. While job growth demonstrated resilience, the potential of the economic slowdown is leaving investors and analysts alike on edge as we all wait for the Federal Reserve's response. The central bank's upcoming interest rate decisions carry significant weight, as it will likely influence the trajectory of the economy in the upcoming months. On to point number 4, the Fed rate cut update. The Federal Reserve is widely expected to lower interest rates at its upcoming meeting on September 17th and 18th. This comes as the U.S. economy exhibits signs of slowing down, prompting the Fed to shift its focus from curbing inflation to supporting employment. While the August jobs report showed an increase in jobs growth, other indicators such as slowing wage growth and a decline in job openings suggest a cooling labor market. Despite the likelihood of an initial rate cut, we believe a more aggressive 50 basis point cut is unlikely, barring any significant economic deterioration. Such a move would send a negative signal about the state of the economy, and a more gradual approach is warranted. The Fed will likely rely on incoming economic data to determine the pace and magnitude of future rate cuts, with the ultimate goal of achieving a soft landing for the economy. And that, friends, concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting the like button, you help push our content out to other viewers and listeners all across our social media outlets. If you'd like to see our latest videos on your feed, including new content released by our team, please make sure to subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below and schedule a meeting. Thank you for watching. We look forward to seeing you next week.